Hello, this video serves to complement the missed recording part of our video conference just ended momentarily ago. So basically, what was not recorded in that conference is the first part of question 4 of your assignment. So in this assignment question, you need to answer a few questions related with the financial statements. So some of you were confused that in question A, you're not able to solve for cash and equivalents because the total current assets was not given. However, the missing total current assets should not pose a challenge to you. Okay, I know where that comes from. Cash plus current assets plus inventory account receivable equals to current assets. But there's another way to solve for the cash in the year of 2019. That is, cash in 2019 equals to the cash in 2018 plus the net change of cash. Okay, the net change of cash in the statement of cash flows. So the company had $80 cash a year ago, and it wants to know how much cash you will end up with in the next year, 2019, then you should know how much the cash would change. So if you browse the statement of cash flows, then you would see the net change of cash is negative 58. So that comes from all of these activities joined together, reduce the cash by $58. So basically, this would be 80 plus negative 58. And for accumulated depreciation, it would be the accumulated depreciation of last year plus the new year's depreciation expense, which is 100. And for retained earnings, that's the retained earnings of last year plus the net income this year minus the dividend of this year. And how do you get time interest to earn ratio? That's the easy one. You just use the earnings before interest and taxes divided by interest. And for the quick ratio, it will be current assets minus inventory. Okay, so inventory is the least quick part of the current assets. So what are the quick parts? I mean, quick means easy to be resolved, easy to be changed to cash. So those easy part would be cash and account receivables. Okay, so you just need to find all this information. Do you have a total current assets? If you didn't do A, you don't. But after you finish the A, you can use the summation of the three to get total current assets and then divide it by the total current liabilities. All right, and for change in account receivable, this is from the balance sheet. So you have account receivable right here. It increased from 315 to 375. Then in the statement of cash flows, it should be have a negative impact on cash. You see, if your assets increase, then your cash should be reduced. If you have more uncollected bills, that basically hurts your cash reserve. And then you have a change in accounts payable. So let's say if your account payable is right here, it increased from 30 to 60, then your cash must be increased because you have more liabilities now. When liability increase, your cash increase. Okay, instead of paying them cash, you increase your debt amount. So that helps you save cash. So this part should be positive. And when you do the dividend here, make sure the dividend is borrowed correctly from the income statement, and make sure the dividend in the statement of cash flows should be a negative input. And for this question, based on the provided financials, the firm sales inventory, and what is your new quick ratio. So as I mentioned earlier, the quick ratio is current assets minus inventory divided by current liabilities. So if you finish the previous question, you had the old quick ratio. So what happened to the new quick ratio? You need to check what is your new current assets, what is your inventory, and what is your current liabilities. Okay, so if the inventory is sold, then that means cash would be would increase. Okay, and the inventory goes down. Okay, decreases. Okay, so you see the inventory decreases. Definitely, that's a part of your consideration in the calculation of a quick ratio. But what happened to your current assets? Your current assets equals to cash plus inventory plus account receivable. Well, account receivable does not change. The cash increased by 40,000, inventory decreased by 40,000. Then basically the change would cancel each other within the domain of the current assets. Okay, so when you add the increase of cash and subtract the decrease of inventory, your current assets basically stay the same. So the only thing that would happen here, make a change here, is the inventory. Your current assets and also current liabilities stay the same. So that's gonna make your new quick ratio.